Welcome back to Yuri's Box. In this video, I'll be answering more of your thoughts from the comment section, and we'll be going over TLT, the dollar index, the DXY, as well as perhaps gold a little bit, and the Federal Reserve. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So again, if you're new to the channel, this is what I like to do. It's a more of a thank you, my way of saying thank you to everybody for liking, subscribing, and helping grow the channel. Again, this is my way of giving something back. Again, I go to the comment section, and if I find any thoughts that I find that tickle me in a particular fashion, I'll perhaps consider making a video about your comments, such as this one. So let's jump right into it. This one is from Robster2828. Yuri, do you think US getting involved in another never-ending war helps or hurts TLT in the next 4 months? Thanks as usual. This is a tough question to answer, to say the least. Let's start off from what I definitely think will happen. The next 4 months, in my opinion, and I could easily be wrong on this, the news flow definitely is quite chaotic. Things could escalate on a moment's notice. I could be making this video and it could be outdated by the time it comes out. But my base case has always been, and will continue to be until proven otherwise, that the economic data will be king. We will go back to having to face the music of the economic data, whether it's better or worse. That's been my base case ever since we got through the tariff drama in April. And I haven't been totally correct on that, because again, the market still hasn't really faced the music in that regard. Because again, the economic data has generally been negative. The PMIs have been lackluster. Housing data, again, yesterday was quite bad. Retail sales were quite bad. Initial jobless claims continue to be quite bad. Continuing claims continue to be quite bad. Non-farm payrolls, although, they have been, generally speaking, sometimes a little bit better, on the headline. However, the revisions have been abysmal, all right? We went from 140 to 110, 150, 100, 228 to 220. God only knows what April will look like. God only knows what May will look like. All right, so the economic data has been negative overall. The economic surprises have been to the downside, but the market still really doesn't seem to care. And that really leads me to the main point that I wanted to make. When thinking about what could happen, to TLT in the face of a potential war. Again, we're just thinking hypothetically here. It's a tough question to answer, because what you're really asking here is, how will the bond market interpret a war? Will it say that the war is a total risk-off event where we just have to buy the long end of the curve and bonds in general, and so we have that flight to safety bid? That's a possible scenario. Does the bond market say it's inflationary? Full stop. Like we started to see, in the beginning of the week, on Monday especially, where we went up by, 6 or 7 basis points here compared to Friday, on the back of oil going up by quite a bit. All right, because again, oil going up is inflationary, and you know the drill. So it could be a risk-off event. It could be inflationary. It could also be, again, another risk-off play, meaning that yes, it is inflationary, but it's the kind of inflation that I've been touting, if you will, meaning that a form of disinflationary inflation. Given what we know about the labor market, and the constraints that any further bout of inflation could have on households and businesses. That could be another way the bond market interprets things. We could have more of what we've been having ever since April, stagflationary environment getting priced in. it's really down to how the bond market would interpret that kind of event and how severe the event would be. All right. So again, it's really up for grabs, honestly. And this is really important to keep in mind because it ties back to something that I've been hammering about, ever since I've been making videos. I spoke about it ad nauseum yesterday in yesterday's video. But again, just because the data says one thing doesn't mean the bond market goes with that data. The bond market in this cycle has been wrong every step of the way, in my opinion. All right. You were far better off following the stock market and just being optimistic, because whatever the bond market has said in this cycle has been proved wrong. All right. If you look at 2022 and 2023, we're gonna have a recession. No recession. We have to play catch up, and we're gonna go up to 5.2% on the 30-year bond. Then we say, you know what, inflation might be well behaved in the following months, so we might be able to get away with lower yields. Inflation is not well behaved. We're gonna have higher for longer. Oh no, wait a second. There's a growth scare. The yen carry trade. The world is gonna end. Recession. Oh no, wait a second. We're gonna have stagflation. You get the picture, all right? The bond market can get fixated quite easily with a certain theme, a certain narrative, until it is totally untenable. And only then will it reverse course. We've had many bouts of this throughout this cycle. Again, recession in 22 and 23, higher for longer in 23 and 24, recession in summer of 24. Now we have, excuse me, now we're looking at stagflation. You get the picture. It's really a matter of how the bond market would interpret that kind of event. And also consider that just like the tariff drama, it all could end with a post on Truth Social, right? Like even last night, I was about to go to bed. I looked at the last headlines, and they were quite contrasting. On the one hand, you saw basically all that was missing for the US to bomb the hell out of Tehran was Trump's green light, and on the flip side, you had reports coming out of the New York Times, if I'm not mistaken, that Iran was open to meeting with Trump. Trump was open to meeting an Iranian delegation at the White House or something like that. Either could be true, could easily be true, and they could easily be confirmed by just a post on Truth Social. So keep these things in mind. As far as these events are concerned, the best way to really treat them is to go day by day and try not to look too much into the future. And try, generally speaking, to expect the best out of things. Don't give in to the doomsdayers, because the doomsdayers are rarely right. If that weren't the case, we wouldn't be making videos here. We would be hiding in our bunkers, eating canned corn and tuna. All right, so keep that in mind. And again, try not to get distracted. In my opinion, I think that again, the best the best thing you could do right now is pay attention to the data. Don't lose sight of what the economic data is. Don't lose sight of non-farm payrolls, unemployment rate, some housing data if you're interested in that sort of stuff. PMIs, all that good stuff. CapEx, intentions, all of that good stuff. Look at that, because that will, in my opinion, tell you where yields have to go eventually. And I stress eventually, because again, the bond market can easily get fixated on a certain theme and stick with it for quite a while, as history has shown us. All right. So hopefully that answers your question. I really didn't give an answer, but again, it's there's a lot of things to consider. How things could play out and how the bond market would react to those events playing out. It would be really up to grabs. You have risk off and you have inflationary narratives that could easily take place either way. So hopefully that answers your question. And moving on to another comment, which I've actually been wanting to answer for quite a few days now. And this one is by Cam Sedin. Hopefully I didn't butcher that name. If I did, I apologize. I apologize. canceled in 1999. The only thing that bothers me is the selling of treasuries. All right, like debt wants more yields to be served. Last stock market sell-off in April was accompanied by selling of treasuries, which is new. Bond market, market up, bonds down, market down, bonds down. So this asset is doomed. The thing is, I'm not sure, is bonds are doomed for good, as we know this debt will not be paid back. Listen to Dalio and Jamie Dimon. So again, this is just me giving back to the viewers, answering comments. I'm not really interested in convincing anybody. This is just me saying thank you again, just to reiterate. I want to make one thing clear before I move on to the first part of the video of the comment, and it's this last part right here. I think I'm not sure the data will not be paid back, and listen to Ray Dalio and Jamie Dimon. All right. Now I want to get one thing clear. I'm a schmuck with a YouTube video with a YouTube channel, right? And I'm about to talk about billionaires with a B. All right. So it's important to remain humble. Just reminding myself, all right, that I'm talking about billionaires. But regardless, I love both Ray Dalio and Jamie Dimon, especially Jamie Dimon. All right, whenever they speak, I listen. Full stop. You know, there are people that certainly know more than I do. And again, whenever they have something to say, I listen. Now, just like in real life, whenever I come across somebody that knows more than I do, all I do is shut up and listen. That's, the best policy in my opinion. Now, having said that, it is also important to remember that just because someone is an expert, someone is very high up and is famous, is a big shot, and I mean that with the utmost respect, that does not mean that they can't be wrong. Okay? And if we look at this cycle, for example, in 2022, Jamie Dimon says, brace yourself for an economic hurricane caused by the Fed and in Ukraine war. And this was in June of 2022. June of 2022, if you look at the stock market, was right here. Basically the bottom, if you will. And again, we had the Ukraine war, we had the Fed hiking rates to high heavens, as far as, it was quite a while since we saw interest rates that high. Right, we were coming out of the 2010s. We had, again, the Ukraine war. We had the specter of a recession. And out comes Jamie Dimon and he says, we're going to have an economic hurricane. You better brace yourself. JP Morgan is bracing ourselves, and we're going to be very conservative with our balance sheet. Oil could hit 150 or 175 barrels a barrel, he said. Commodities could go through the roof. What else? Well, you get the picture, all right? And I could give you another example. It's not Ray Dalio, but it's Nouriel Roubini. Dr. Doom says a severe recession will cause the stocks to drop 25% and one zombie companies are in danger. And this was December of 2022. December of 2022 was right here. We were just coming off of the lows. And why am I pointing this out? Well, they basically picked the bottom, if you will, if you want to be extremely harsh. And it's really, I don't want to point the finger at them. I really want to point the finger at us, at, more the retail crowd. Because one of the problems that we have to face is that buying the bottom is hard. All right, we like to think of ourselves as, these Michael Burrys, if you will, where we buy something that everybody's bidding against and we're proven right and we're billionaires and we get to ride our Lambos. That's usually not what happens, because we, in the Big Short particularly, we tend to ignore the middle part of the video, where Michael Burry is losing 1.4 billion. Okay, and we tend to skip to the fun parts. The problem is that at the bottom, generally speaking, you will never pick the bottom. All right, you'll never buy this tick right here. You're gonna buy around here, here, maybe here, maybe if you're lucky right here. But overall, more or less, your average price, buy-in price will be somewhere right here, off the lows, and you're going to be in the red. That's generally speaking what happens usually if in the retail crowd. And the reason why it's so hard to hold on to that golden ticket, if you will, because again, if you look at what happened after, that was a golden ticket. Even if you bought at 4,100, you did great, okay? But you probably still had to stomach, that, all right, which was less than ideal. And the reason why it's so hard to do is because at the bottom, you are constantly reminded of all of the reasons why you should not buy the bottom. All right. At the bottom, nobody wants to buy the bottom. At the top, nobody wants to sell the top. That's how these things go. You have to act in a counterintuitive manner. You have to go against the grain, and you have to go against what everybody is reminding you of. All right. That it's a terrible idea. And the reason why you have to block that out is because the people that buy right here are the people that get rewarded for the courage of having bought down here in the future. All right, so you buy at lows, it takes a lot of courage. That's what that's what you're getting rewarded for. 1 year, 2 years out, whatever, however time it takes. All right. And that's quite important to remember because again, it ties back quite well, in my opinion, to the first part of the comment. Treasuries are doomed. The sell-off in April, you saw stocks going down, dollar going down, and yields going up. Regardless of what the stock market was doing, bonds just seemed to get hammered. All right, and this ties back to a theme that I actually, last time I spoke about it was actually in April, and it is actually the theme of mostly the correlation between the dollar and yields, if you will. You can also tie in the stocks in as well, but we'll be focusing mostly on the dollar and yields because again, what I've tried to do in April is kind of remind everybody that while the narratives and the events might be unique to this cycle, the way the market has reacted and the way markets react in general are definitely not unique. Now that doesn't mean that again the events causing it aren't unique. It just means that the way the market reacts probably has already happened in the past. And as I'm going to show you again in this video, that's mostly the case, okay? We can look at a few of the last recessions, for example, okay? And we're going to look at the 30-year bond and the dollar, as well as a sprinkle of stocks, all right? So what happened right here in April? We had the bond market is collapsing narrative. Bond market collapse, bond market collapse. We had the dollar collapse, right? The dollar's collapsing and actually bottomed out at 97. And we had stocks going down right here. And again, we had this sell America trade, all right? Now, what was very scary to most, again, stocks going down, okay, we can get that because, again, we have a lot of international companies that are looking to the world, tariffs that screws with their, with their profits. But what really got people worried was this. The dollar going down and yields exploding higher. And this was followed by, numerous narratives. I don't even remember, but it was a mess. It was a mess. And I went on the record saying the following. While the events are certainly unique to this cycle, this price action certainly is not unique to this cycle. Exhibit A, 2008. What you see highlighted in yellow are periods of time during which you saw the dollar going down and yields going up. These circles are dramatic events, if you will. March of 2008 signals the collapse of Bear Stearns and really the beginning of the collapse of, well, really the beginning of the 2008 financial crisis. All right, this was kind of the first landmark where we started to realize that, you know what, things ain't too rosy. And sure enough, if you look at from January, where yields bottomed, they went up by 15%, 60 basis points. Okay? Keep in mind, this was a period of time where non-farm payrolls had already started to turn somewhat. We also had high inflation during this time frame right here. Keep that in mind as well. And at the same time, if you go back in history and look at the dollar index, what was happening in dollar land? Well, the dollar was going down. Right here, we had a 8.5% decline in the DXY. Sound familiar? We go from here to here. It's about a 6.4% decline. All right, substantial. Same thing for yields. It's even worse this time, actually. All right, we go up about the if you count the wick, 68 basis points. If you don't count it, 54 basis points. All right, familiar. And if you look at the stock market, what was happening during that time frame as well, lo and behold, was mostly sideways action. But again, not really. All right, let's be conservative here with our measurements. 9% down. Again, I stress the events that took place in 2008 are quite different to the events that took place in April of this year and April and May of this year. But the price actions are not unique, as you can see right here. And again, just to look into the future as well, this happened as well during September of 2008. All right, September of 2008. What happens in September of 2008? Why is September of 2008 so important? Lehman Brothers. You have Lehman Brothers collapse. All right, it was basically game over. Game over across the board. Economy's in the toilet. Financial markets are in the toilet. Everything's in the toilet. All we needed to do was flush. Okay, so sure enough, all right, you have the peak here. Let's do this right here. The dollar went down about 3%. If you count the wick, right here, about 4% if you count the wick. What did yields do? Surprise, surprise. Yields went up 40 basis points. And the stock market, while it was only a wick, it was a 10% decline. And again, what followed after was, much worse, of course. Again, I'm not comparing that, I'm not saying that we're living through 2008 today. I'm just pointing out that the price actions that we're seeing today aren't unique. And again, before I give you, the final punchline, I'll also throw in 1990, just for reference here, because again, we saw the same exact dynamic play out from what was this? July of '89 till September of 1990, yields went up by quite a bit, to say the least. All right, by 140 basis points, less than ideal, for owning bonds. And the dollar at the same time went down. All right, measure it from right here to here, about a 15% decline in the dollar. All right. What follows that, and what you have highlighted in green, is exactly the opposite. What follows this kind of decline, this is something I pointed out in April. Eventually, what happens is that you go from a lower dollar and higher yields to higher dollar and lower yields. Eventually. Doesn't mean next week, doesn't mean tomorrow. Eventually. When we see this mechanic play out, at least if history is any indication, you could expect the dollar to rally and yields to come in lower, as they did in 1990, as they did in the first part of 2008, and in the second part of 2008, when we actually had priced in the recession. All right. Again, just because again the events might be different, the price action isn't. And again, to me, what this signifies, and again, I'm not judging the comment right here, it's just a judgment of us collectively, rather, is that to me, the fact that this price action, meaning treasuries getting sold off, stocks getting sold off, and the dollar getting sold off, the fact that that feels new to all of us just is another symptom of the fact that it's been so long since we've lived through a proper business cycle. Meaning anything before 2008. And everything that happened, before 2008. It's been that long since we've had to live through the pre-2008 world. Because again, the 2010s were unique. I've said that many, many times. And again, I'll go over just to give some context here. To me, the 2010s were years of malaise. And it's not that we didn't have recessions because the Fed outlawed them because they had low interest rates. The Fed was reacting to the weakness in the economy. It was reacting to the low risk-taking environment that took place after the 2008 recession, because people were afraid of having to live through another 2008 recession. And so that was what they were reacting to. Because again, the Fed isn't a proactive actor, is a reactive actor, if you will. The Fed does not look to the future for answers. It looks to the past. Full stop. It waits for something to smack it in the face, and whatever is smacking it in the face, that's what it reacts to. Full stop. All right, I've made videos about that in the past. Just for the sake of keeping this video short, I won't dive into that. If you will, if you want to hear more about that, comment in the comment section, and I'll if there are enough comments, I'll consider making a video about that again. But again, the 2010s were years of malaise, which really didn't provide a boom and bust because there wasn't a boom in the first place. People weren't willing to take risks, meaning they weren't willing to overdo it on the upside. And so what you had was this slow grind higher, what you see here in the quits rate. It took us 10 years to get back to where we were in 2005 and 2006. Full stop. All right. The 2010s weren't a normal business cycle. We didn't have a business cycle in the 2010s. We had a slow grind up, where you had low inflation. We were trying to spur inflation, and low growth. All right. Low inflation, low growth. That's what the Fed was reacting to when they were doing QE. It's not that we got away with QE because we got lucky. QE was a symptom of the weakness. That's the way I look at things, okay? And again, just to reiterate, the 2010s finished with COVID because COVID really catapulted us out of the 2010s, because we are no longer in an environment where people say, you know what, the stock market goes up, I'm not going to spend it, I'm just going to feel good, and I'm going to keep it in case, stuff hits the fan, because I don't want to get caught with my pants down like in 2008. All of a sudden COVID comes along. What happens? We get locked up. We can't go to a restaurant, we can't travel, we can't go to cinemas, we can't use services. The minute people are able to do all of that good stuff, they also get cash injections by the government. We get monetary stimulus. So what do people do? They go out and spend, and they spend a lot because, hey, what if we get locked up again? What if another pandemic comes along? So people spend, spend, spend. They overdo it on the upside, which to me just tells us that the economy has shifted away from the 2010s. Again, this is kind of where I agree with Jim Bianco, that the economy has fundamentally shifted away from the 2010s. But where I disagree with him is that it's not something unique. It's not brand new. It's the same old stuff we saw in the pre-2008 world. That's the way I'm going about the current events. This will play out, in my opinion, like the pre-2008 world, where people overdo it on the upside and they have to give some of it back on the downside. Boom and bust cycles. All right, and that is why I look at the pre-2008 price actions. And again, the fact that that you see kind of the same things play out that we saw this time around, to me is further proof that at the very least it's totally not unrealistic to say that we're in a pre-2008 environment. All right, to me it's just further confirmation. Now again, I could be wrong. I could be wrong in expecting higher dollar and lower yields, but at least as far as history is concerned, that's what usually happens. So we'll see how things play out. Now, as an added bonus, I'll give just a quick talk about the dollar while we're at it, because you'll know, my bias for the dollar is that I'm generally bullish on the dollar, for the simple reason that for all the problems the US has, the rest of the world has bigger problems than the US. Full stop. If you will, to use a famous analogy is, it's the cleanest dirty shirt in the dirty pile or something like that. So overall, I'm generally more optimistic than, say the BRICS boys, if you will, on the dollar. And to me, this is kind of a bull flag, if you will, major bull flag in the dollar. Now, has the dollar bottomed? It's kind of the same. I'm kind of thinking in a similar fashion of TLT, where you might have a final flush lower and then you might move up. Again, and looking at the DXY, what does that mean? Potentially going back down to the 96 level, which would equate to the lower bound of this parallel channel. And if you look back at history, the $96 region, the 96 region, kind of has some importance. Again, right here was acted as some resistance. It acted as resistance in 2018 and as support in 2020. You can see a lot of action right here in 2015 and 2017. Just go back, resistance in 1994, and on and on and on. So I would not be surprised of another flush lower to $96. But again, there has been a lot of dollar bearishness. So again, I wouldn't be surprised if the dollar actually reverses. Now, this could easily flush down, and we could go down to the 90 range. And again, this video could sound ridiculous by the time it comes out, and and time goes by, and 3 or 4 months we'll be at 90, and we can all come back and laugh. But again, I'm fairly okay with sounding ridiculous and saying ridiculous things. That's kind of my way of my mojo, if you will. And if we were to get a dollar rally, I would not be surprised, again, if we were to see this play out. The green bars, meaning higher dollar and lower yields. Given also the fact that we are approaching the summer, we know that during the summer we get initial jobless claims going up. We know that the starting point for initial jobless claims is higher than last year. We know that continuing claims have been going up, and we know that during the summer we tend to see some kind of malicious, developments in the continuing claims. And we know that where's the tab? Right here. We know that non-farm payrolls have been weaker than last year. Just look at the reads, and we know that the revisions have been quite worse than last year. Just look at March. Let's look at how April and May come out. All right. So again, I'll probably leave it at that. Hopefully that answered all of your questions. Give you some of my thoughts here. What I generally try to preach on my videos is that never give in to, if you have to choose, let's put it like this, you have to choose between the doomsdayers and the uber bulls, always choose to be an uber bull rather than a doomsdayer. Because the doomsdayers, as I said before, are never right. Because if they were right, I wouldn't be making videos here. I would be hiding in a bunker, reliving Fallout, all right, the Fallout series of video games, eating canned tuna and, buying, I don't know, plastic bottles with beer bottle caps, whatever. So if you have to choose between the two, be optimistic. At the same time, don't be blind, and don't blindly listen to the news flow, because the news flow is full of distractions. Just look at Jamie Dimon, right? I love Jamie Dimon. I'm not saying he's an idiot. I mean, he's a billionaire. If he were an idiot, he wouldn't be a billionaire, right? There are plenty of idiots that happen to be billionaires as well, but generally speaking, he's not an idiot, all right, as far as Jamie Dimon is concerned. But again, just because he's a billionaire doesn't mean he's absolutely right, 100% of the time. Just look at what he was saying in 2022. Look at what he's saying now. He's saying that we're going to have stagflation. It's going to be bad. Even Ray Dalio right here said that bonds were spooky. As far as, this local top at the very least is concerned, that could actually mark the peak in bonds and yields. All right. Wouldn't it be ironic that Ray Dalio comes out on Twitter, on X, he makes a video, pay attention to the bond market, bonds are spooky, bonds are telling us, giving us a warning. Wouldn't it be ironic if that was the top in yields? I mean, I'm not saying it is. I mean, you could easily point to this price action and say this is a bull flag in yields, easily. And again, as I said before, the bond market can easily get fixated on certain themes and go along with it longer than it should. So could easily happen. But again, just find a middle ground between being open-minded and hard-headed. All right? Open-minded because you might be wrong. Hard-headed because just because somebody is, a big shot, and again, I mean that with all due respect, they might still be wrong. All right? They might end up being wrong. All right, so again, hopefully this video was informative. You enjoyed it, and I'll see you next time. Bye-bye.